Hello and welcome from Trend Signal for a review of the data and events the week beginning the 13th of April. This is the first full week back after the Easter break, so no holidays, which is good. We have a moderate to busy calendar this week with inflation or perhaps deflation data coming out in the UK, US and the Eurozone, and monthly monetary policy meetings from the ECB and Bank of Canada. Last week, we saw equity markets put in a pretty good performance. Certainly the FTSE up 256 points or 3.75%, really on the back of the Shell bid for BG, which sort of sparked the energy sector and UK markets in general last week. Retailers were also buoyed by recent results from the likes of M&S, with a lot of supermarkets, etc., rallying despite the ongoing price war. Overnight news, we've had some fairly dire data out of China. The trade balance came in a lot worse than expected. The imports for March fell 12.3% year on year. We're expecting a fall of 11.3%, but exports were appalling. I mean, they really were shocking numbers. March exports fell 14.6% year on year, and the estimates, the consensus for a rise of 8.2%. So a fall of 15% in March against a year earlier, and a sharp reversal of the last 2 months' growth, which now has precipitated quite a lot of fears about the Q1 economic growth and the forecast for that. We've actually got China's GDP data out on Wednesday morning, and the official estimates are for 7%, and the state tends to deliver on its official estimates, although there are real concerns that there is a significant slowdown in China now that obviously will have an impact on global growth, and that's why economists get very excited when the data disappoints. However, the madness that is the Chinese stock market continues to persist, which saw prices continue to rise in the Shanghai Composite, which added another 1.1% overnight on Monday morning in the first hour of trading, and that's on top of a rise of more than 25% already this year. The Shenzhen Composite Index, which is the smaller one compared to the Shanghai Composite, climbed 0.8%, but that takes its 2015 gain to 53%, which is just gopping. And it outpaces the world's second best equity market, Venezuela, by more than 10%. But an extraordinary move, and when you get headlines like this from MarketWatch, China Stock Connect, more boom and bust, you've got to wonder exactly what's going on there. From the FT, export slump stokes fear for China growth. So really, to see the sort of moves we're witnessing in the stock markets, it does not make a lot of sense. Last week, not all positive news for the sterling markets. The British pound against the dollar, that hit a 5-year low, I guess due to the political uncertainty, as polls don't seem to be moving positively for the Conservatives. Labour's plans on non-DOMs, Mansion tax, increased state intervention, I guess, are starting to worry investors, but more probably the fact that it is pointing, obviously, to a hung parliament with no progress either way, really. But it wasn't just sterling last week, though, that fell. The euro fell further as recent dollar weakness was reversed. In fact, Goldman Sachs has posted a very negative outlook for the euro. It's targeting euro dollar at 102, that's 1.02 by September, and by March next year, it's got a target rate of 0.95 for March 2016. But if you look at the euro dollar on a daily chart, or even I should say on a daily chart, in fact, if we have a look at it on a monthly chart, it'll be a lot clearer, and you can see exactly how far this particular pair could go. It's certainly possible that it could sink right back down to the sort of 85 handle at some stage. Certainly, there's no reason why it should stop at 0.95, which is that target by Goldman's for next March. Other news, well, iron ore has continued to slump, falling now over 25% on the year. That's below $47 a tonne now, which is really hitting the Aussie dollar. If we look at the Aussie dollar now, just on a daily chart, we can see the fall that happened overnight. which I guess in addition to the poor Chinese data, has given the Aussie dollar a real a good kicking on Monday morning. Data and events this week. Let's have a look at our calendar. Relatively busy. We got inflation data, as I say, or deflation data, and a couple of meetings to report on. UK inflation is out on Tuesday morning. That's the the CPI, the Consumer Price Index. An article in The Guardian on Monday is entitled "UK Economy Poised to Welcome Deflation for the First Time Since 1960." I guess it's because, according to the Bank of England, good deflation is what we're experiencing, down to a few specific issues such as oil and the food price war I mentioned. Damaging deflation is where there is an underlying fall in goods and services across the board, and that is not what is happening, certainly not at the moment or yet anyway. The Bank of Canada has its monetary policy meeting this week as well. The governor of the Bank of Canada described the oil price plunge as atrocious for the economy, but we believe that with the stabilization in the price of oil, that there will be no cut in interest rates in Canada. That is on a Wednesday at 3 o'clock in the afternoon. However, obviously, it could be all change if there is a deal done with Iran, which sees its oil export sanctions reduced, and therefore more oil flooding the market, and the price will go lower. We also have on Wednesday the ECB monthly policy meeting as well, which normally happens on a Thursday, but Wednesday this month. Interest rate is expected to remain unchanged at 0.05% with a negative deposit rate of 0.2%. There is another article in the FT referring to yields on German bunds will be negative soon, which is not such a tough call really when you look at where yields are at the moment. Yields on bunds last week dropped to 0.16% on the 10-year, which is extraordinary. That compares with 0.54% at the beginning of the year. Obviously, the effect of quantitative easing, the ECB is attempting to push rates lower, weakening the euro, and hopefully avoiding a deflationary slump or spiral in continental Europe. But there are consequences for this policy, which means the possibility of these negative yields. It is a scenario where investors pay to lend their money to governments and are guaranteed a loss if they hold the bonds to maturity. Not a great sales pitch, really, is it? Other data out this week in the US, we have some manufacturing data on Thursday, which is starting to show signs of upticking again, which is good news for the US economy. And then on Friday, we have our unemployment data in the UK in this election period. We don't expect to have too many effects on the markets, obviously. And then in the afternoon, we have the US inflation data, and very benign that it is a slight uptick as energy prices stabilize. And then at 3 o'clock in the afternoon, we have the preliminary reading of the University of Michigan's consumer sentiment, where the US consumer is remaining quite happy and contented with a reading of 93.8 up from the previous reading of 93. That's it for the week in terms of data. Obviously, the markets are quite active. Certainly, currency markets, the foreign exchange markets are very busy, looking at sterling and the euro. Equity markets, well, certainly DAX has proved to react again very positively to the fall in the euro. Let's see where the euro goes this week. It may encourage further buying of German stocks. Thank you very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.